Corporate Finance OneNote Practice Problem. In this presentation, we will work a practice problem in OneNote related to the calculation of total asset turnover and return on equity. We're going to take a look at a bit more complex relationship as we go through these calculations than we've seen in prior presentations. Get ready. It's time to take your chance with Corporate Finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 325 Total Asset Turnover and Return on Equity More Complex Relationships tab under the Practice Problems section. Closing this back out, we're going to have our information up top, then we're going to go through our calculations below, including the total asset turnover. We're going to look at the relationship between the return on assets, gross profit margin, and the asset turnover as we go through that calculation. And then the return on equity, once again, looking at the relationship between other ratios, including debt to total asset, equity to asset, return on assets, and return on equity. Let's go back up top. Our information up top, we have the gross profit margin, and we've got the return on assets. So note the information that we are given are the end result of the calculations for the gross profit margin percent and the return on assets. And normally when this is the case, then I would basically write down the information, write down the formula, look for the unknown. Now they didn't give us any other piece of information, so you would think, well, there's not going to be an unknown there that we're going to have one piece and then we can derive the difference between it, because you would think you'd need one more piece. But there's going to be a relationship between these two items. So we're going to do a similar process. If you know that relationship, you could just work through the problem. But if you don't know it, you can kind of derive it with the same kind of system. We're going to write down the formulas for these items and look at them and see if we could see the relationship to be able to work the problem. To take these two items, and what we're going to be looking for is the total asset turnover, the asset turnover. So we're looking for then the total asset turnover. We're going to be using the items of the return on asset and gross profit margin. So let's consider those calculations. Let's consider the return on assets. That will be calculated as net income divided by assets. Now remember, you're talking about an item here, return on assets, that has an income statement account and a balance sheet account. So you might see this reported as the average assets in the numerator, so just be aware of that so it doesn't confuse you. Depends on the context, what you're working in. Then the gross profit margin is calculated as net income divided by sales. These are both income statement items, so we don't have to worry about any kind of calculations that would be of different time frames and therefore having that average kind of issue going on. So notice if we look at these, we're going to say, okay, we have these two items. We're looking for the total asset turnover. And so the total asset turnover, what we're looking for is to have sales over assets. That's going to be the total asset turnover. So if I look at the information here, I'd go, okay, net income, and then I've got the assets and the sales. And what I'm looking for is sales over assets, right? So if I can basically have the reciprocal of the gross profit margin, then we might be able to cancel out the net incomes and end up with sales over assets. Well, how can you do that? We might be able to divide the fractions. So what you would do is you'd say that we will then have the net income over the assets, which is the return on assets, and divide then the net income over sales, which is the gross profit margin. So these are two fractions that we have. We're going to divide them out. The way to divide them is to convert this to a multiplication problem so that we take the reciprocal of the second fraction here. So then we're going to take we have the same amounts here, income over assets times, and then we take the reciprocal, sales over net income. So what we're left with then is something that we can cancel out the net incomes now. Net incomes will cancel out. So this will then equal sales divided by assets. Therefore, if we have the calculation of net income to assets, or the calculation of return on assets and the gross profit margin, we could take the return on assets divided by the gross profit margin. So that's what we're going to take here. We've got our information up top, the 5.7 gross profit margin, the return on assets. We can then say, okay, we got the return on assets is going to be the 1650 gross profit margins, the 570, and then we will divide them out. I'm going to calculate it just so that we make sure that we have the rounding involved. So we got the 16.5 divided by the 5.7. and that's going to give us the 2.89. Notice I didn't move the decimal over, so if you move the decimal over, it'd be the same thing. 0.165 divided by 0.057 in terms of a decimal format. You're going to, let's do that one more time. 0.165 divided by 0.057, and you're still going to get that 2.89. So note that we do have, of course, rounding involved. We always want to keep in mind the rounding that we're going to have involved, and I do recommend working these in Excel so you get used to the formatting of rounding and how rounding is going to be affected when you utilize the cell in a rounded number. Okay, so now we're going to calculate the return on equity. So it says here, if debt to total assets ratio is 30%, what would return on equity be? So we have the same information up top, and then we have if the debt to total asset ratio is this 30%, then we're looking for the return on equity. So let's write down these relationships here. We're going to say we're looking for return on equity. Return on equity is going to be net income over equity, net income divided by equity. What we have is the debt to total assets, which is exactly what it would sound like, debt to assets or liabilities compared to the assets. What we're looking for is something with equity. We want equity involved here. So note that with the accounting equation being assets equal liabilities plus equity, if we know that liabilities over assets, if we know that number, then we can take 100 minus whatever that number is to get to the equity over assets. So in other words, if I know the debt to total assets, then I can figure that. Once I know that number, I can figure equity to total assets. And that'll give us an equity number, an equation with equity in it. So equity to total assets, exactly what it sounds like, equity compared to the assets. And then if we think about the return on assets is that net income divided by assets, and we were given the return on assets here. So we have the return on assets as well. So now if we compare these two, we can get to the equity to assets and the return on assets, and we want to end up with net income over equity, which is the return on equity. So we can see here that we have net income here, we've got the equity here, and the assets are duplicated. So we'd like the net income, notice, to stay on top, and then we would like the equity to be on the bottom. So I need to take this fraction divided by this fraction, flipping or reversing the sign here. So what would that look like? We can say, okay, let's take the return on assets. So return on assets is going to be the net income over assets. Notice you have to start with that one because this is the one we want to be divided by, because that means we're going to take the reciprocal of it. So we got the return on assets, net income over assets, divided by equity to assets, equity over assets. And then we're going to take the reciprocal of that. So if we take the net income over assets, then we take the reciprocal by multiplying times the reciprocal of the second fraction. That's how we do a division problem with fractions. We take the reciprocal of this, so now we have assets over equity, and therefore we can cancel out the assets. We're left with then net income over equity, net income over equity. And so that's what we want. So that means that if we know these numbers, if we have the return on assets and we have the equity to assets, we can divide them out to get to our return on equity. So what we're going to do then is we're going to say, all right, we're going to take 100% minus the debt to total assets ratio, which is 30%. So they gave us the debt to total assets ratio. Once again, if we have that because of our accounting equation, if I have liabilities to total assets, then I can take whatever that is, 100% minus it, in this case 100% minus 30, and get to the equity to total assets. So that's going to give us the equity to total assets, which then is 70%. So once we have the equity to total assets, then we can take the return on assets, and what we've got to make sure we're going the right way here. We want the return on assets divided by the equity to assets. So we have the return on assets is this number, so we're going to go kind of backwards here in the calculation, the 16.5 divided by the 70, or in other words, let's do it with the calculator here, the 16.5, let's do it, let's make them into a decimal, 0.165 divided by 0.7 is going to give us, let's do that one more time here. Let's see, we got 0.165, moving the decimal over 2 places to get 0.165 divided by 0.7. 0.7 is going to give us, okay, then if we move the decimal over 2 places, we got the 23.57 about. So that gives us our return on equity with that relationship. The last one says, if debt to total assets ratio decreased to 20%, what would be the return on equity? What would return on equity be? So now that we know the system, we could just apply the same thing and apply that 20%. So it would be 100% minus the 20%, getting us to the 80%. And then we're going to be taking the return on assets that we had above. We're saying that's going to remain the same. And then we could take our division, which is going to be the 0.165 divided by the 0.8. And that's going to give us the 20.63 about.